Hello, everyone, and welcome to Market Mavens. Thank you for a great response and feedback on our first episode. Today, we bring to you another distinguished speaker from the industry. He's a CIO with the least airtime. He's an unambiguous favorite amongst peers and competitors alike. He's a man of few but intense words, and his performance does all the talking. I'm talking about none other than Mr. Neelesh Surana. He's the CIO of Mirae Asset Investment Managers India Private Limited. He's been associated with the Mirae Group for more than 1.5 decades. He has a rich experience of 31 years in total, and he spearheads research and investment management functions at the Mirae Asset Group. Thank you, sir, and a very warm welcome.
Thanks, Megha. A pleasure is mine. Thanks for a very generous introduction.
It's our pleasure, sir. Sir, it's often said that your early childhood has a lot of influence on your relationship with money. I'd like to understand how were you as a child and what drew you to the world of finance in the first place? Did you really get exposed to money matters very early on in life?
The family background was like my father served with the state government, and my mother was a homemaker. And it's a typical middle class sort of background. And obviously, your the do's and don'ts on money matters are tight in those days. And but if you are connecting the exposure to money matters with stock markets also, just a background. Even in our extended family, there were none in the field of finance, and let alone, on the markets or so. Or fund management, of course, was not an established profession there. As regards to my interest, I think towards the market, it got sparked during the college days. Whatever pocket money, otherwise, you sort of started participating in the IPOs. And that was pre-CCI, sort of during the CCI days or so. And I think during the college days also, I had very sort of exhilarating experience during the famous Harshad Mehta old sort of period. And there were few eureka moments, and that sort of fueled the fascination. By then, I had completed my engineering, and it just fueled the fascination towards finance, towards markets. And I then deliberately chose to shift gears from engineering to finance. And the transition obviously needed to complete an MBA, then the financial services industry. That's the background.
So, while there's no real formal metric which exists in the Indian fund management industry, but I don't think it would be an exaggeration to say you would easily be amongst the top 5 fund managers in the country. Now, I'd like to understand that, you have been credited with the most stellar performance in your flagship fund. Not only you or the fund house, but even the competition agrees that there has not been any corporate governance issues in your underlying companies for the last 16 years. Now, unlike experiments which are run in controlled environment and where we can alter the settings to get the desired results, the world of business is very complex, dynamic, and messy. So, I'd like to understand from you what is a winning strategy, other than being disciplined or maybe having quality as a line of defense, and how has it probably changed over the last 2 decades?
Yeah, thanks again, Megha, for your generous observation on performance. We completed 16 years. First 14 years where what you said was true. Last couple of years have been not so smooth. In our profession, we are as good as or bad as this last few years. But nonetheless, to your question, I would only first of all stress on one point that when we look at our framework of institutional money management, we are talking of asset under management of north of 1,45,000 crores. So it's obviously not an individual approach or philosophy. There is a proper grid. There is a 15-member research and fund management team. So it's not, that's just to give a context. It's not that my sort of approach is the proper template or the house investment philosophy. Just to touch on that and what drove the sort of fairly decent, satisfactory performance over the last decade. I think the philosophy has two parts, two pillars. One is towards stock selection and one is towards portfolio construction. And that template we have not, that is sort of constant and it revolves essentially in participating in good quality businesses up to a reasonable price, a reasonable valuation. So all the three aspects of stock selection, which is business selection, management evaluation, and the valuation of the business, has been crucial, and it's important to weed out the outlier. It could be subpar in terms of quality of business, be lower growth, lower ROE, or to weed out that, obviously on the management part, and as well as avoid expensive price tag even for great businesses. So that's the first part. And secondly, in terms of portfolio construction, in our format, we have to adhere to a very disciplined diversification sort of approach and construct a portfolio. Actually, a portfolio should be capable of handling both near-term sort of quotational errors or mistakes and yet deliver superior risk-adjusted performance over 5 to 10 year period. So that's the broad sort of approach, and the entire 15-member team do contribute in terms of the research, selection of ideas, and as a fund manager, even on portfolio construction, the analyst has a say, and that's how it has been done in the past.
So, every fund manager has triumphs and failures alike. And, we would request you to kind of share some examples here for the benefit of our investors. Help us with, a lesson on stock that kind of discovered early, and what was your rationale behind the same? And also help us with a real case scenario where, contrary to your expectations, a bet went wrong.
The first part, since we are not at liberty to talk much about individual stocks, but I would say the most of the winners, if I were to put in a bucket, were coming through when valuations were beaten down in good businesses, where the near term was impaired, but the long term was intact. So we don't shy away from taking those contrarian opportunities. As I said, when the near term is impaired and longer term is intact, that gives enough margin of safety, enough liquidity, and enough time to participate in good sort of franchise. And if I had to give few examples over the since inception, there were, let's say, the auto major about, I think, almost a decade back has multiple instances of strikes and fire and stuff, and the EPS near-term forecast literally fell by almost consensus EPS forecast fell by 50-60%, and the stock obviously sort of collapsed. And that was the first time when we picked up in our the current large cap fund, and it was in 3 digits. So price and guessing which name I'm talking about, and that obviously did very well. Then similarly, sectorally, if you look at it, about 7-8 years back, we had the oil marketing companies. Despite deregulation, they were available very cheap. Despite the deregulation was done, it was a matter of when the numbers, it will show in the numbers, and that actually did very well. Pharma sector during the same time did exceptionally well. And there were individual instances, let's say IT major had a big upheaval in the top leadership, and again, the P multiples literally collapsed to low teens, in fact, 12, 13, multiple of an individual name. That time we sort of participated. Or public sector undertakings, many of the names 4-5 years back, be it a fire finance, be it energy utility, etc. We did participate. So I think, without calling out individual names, these contrarian bets, and I would say these good contrarian bets, because anything which is 52-week low cannot be a contra bet. It has to be good franchise, and they are momentarily passing through a bad patch, and that's when you get quality at a reasonable sort of price. You also touched upon what didn't do well. So I think, again, qualitatively, I can say, of course, there are many errors and we constantly learn from them. But I would say that most of the errors have been not of commission, as in what we have bought and led to a permanent loss of capital. But it's mainly to do with many of the errors. I would say the central thread has been more what I would say errors of omission, where we have been conservative or we're not able to comprehend the size of the opportunity. And in that context, we would have either missed it or we would have sold early. So case in point is, let's say one NBFC, we did extremely well. We used to own it, but we sold it quite early and then it did very well. Not the stock price, but even the numbers did multifold. A similar sort of instances are there where I would say, and it's a constant sort of learning. Key thing from an institutional framework is you need to minimize the errors of omission and obviously not commit much of errors of commission.
Right. I think, having a decent margin of safety is probably your mantra of success, if I understand it correct. Now, so, you alluded to the point that any portfolio's success depends on getting the business management and the valuation right. While valuation is more of a quantitative metric, many can probably get it right, but what most struggle with is on the lines which involves a qualitative judgment, which is corporate governance. Now, I'd like to understand from you that what are the unconventional matrices which you use in your primary research, which has kind of helped you, maintain a clean slate of records for so many years?
I mean, management evaluation is extremely crucial. As you rightly said, that it can't be quantified. There are ways and means which can give some idea about quantitative filters. For example, a superior management will have better return on equity for the same sector, within the same sector, will have better capital allocation. That's why better return on equity. They generally will have a good payout ratio and efficient use of capital, and cash flows conversion will be better. All else will be the same within the same sector. That is one way. But again, it is not the only way. And I think it's very important to analyze the management. And there are two aspects, in my opinion. One is what I would say it more like hygiene sort of factor, where it has to meet the basics of corporate governance, etc. The minorities have to be in the same boat, and the management should look at it. As Mr. Warren Buffett said, that three things he looks in evaluating the manager or the management: integrity, intellect, and energy, and in that order. So obviously, the integrity part is basically regarding corporate governance. So there are many things you can do it. External forensic sort of analysis can be done. Dot can be seen by the past track record. Instances like, is the company paying full tax or appropriate tax? How much is the payout ratios? All that can also speaks about the quality of the cash flows. So that is one. But the second aspect about management, which is slightly difficult, is understanding the thought leadership. Do they have the fire in belly to capitalize on the opportunities by taking appropriate risk-adjusted not risk-adjusted, but appropriate risk to capitalize on the opportunities and maintain the modes of the business? So I think herein where, as I said, there is a 15-member team, there are processes, you meet with the company. Obviously, you meet with the competitors, peers, industry experts, and multiple sort of ways and means, including some basics like going through the annual reports, reading in between the line and everything. I mean, so it's not one sort of easy, as you sort of mentioned in the question. It's not so easy way to analyze, and it has to be done on multifaceted way. And there is a proper team which looks at sector or companies, and obviously once you are covering a sector, you get an idea about other peers also. Lastly, I have seen that particularly in these days when a lot of new listings are happening, the company and the management is new to literally entire sort of all set of investors, public investors. So many a times the stock should have a bit of right to win over time. So you get comfort, or about not only on the business, but even the character of the management only with time. Only with few quarterly calls, few years, you can to sort of say with confidence in terms of a track record of capital allocation and multiple sort of aspects. So I think it's slightly much more nuanced, but yeah, you are absolutely right that management evaluation within a sector is super crucial, if I were to say. And we have winners and losers across sectors. And that is one of the factors in terms of how companies create wealth or not create.
Understood, sir. And so now coming back to what Megha was mentioning, one differentiating factor which you have is your performance track record over a longer period of time. And that is a key difference between you and your peer group or your competitors. But there is one unique element of your fund management, especially in one of your funds, which is large and mid cap, where you have had restricted entry for investors. Now, today we live in a world where be it asset management companies, be it advisors, everyone is in a rush to accumulate AUMs. We also do understand that in certain categories of funds like small cap, you need to have some control over inflows so that it leads to no harm for the existing unit holders. But in a category like large and mid cap, what would be the reasons for you not to follow the herd and keep the entry very, very controlled?
Harsh, just to put the facts right. I mean, the soft closure of erstwhile emerging Bluechip was done when it was a mid cap fund, and subsequently the category changed, and we continued with that. So yes, you are right. We were slightly conservative there again at that point in time, essentially to remain more nimble-footed. And as you rightly alluded, at all else being same, obviously relatively smaller AUM do benefit. All else being same fund manager, same mandate, etc. And the reason at that point in time were twofold. One is internally for us, the flow market share, the incremental month-on-month market share was significantly higher than its size or the book market share. It had a very strong month-on-month growth, literally 10% or so, which was not sustainable. And at that point in time, we thought it to make it much more sort of granular. Else it would have become much bigger. It's already the largest in the category at almost 34,000 crores of AUM. The second point I would say is that within the mid caps, and this was a period of 2016, 17, and subsequently a lot has changed. I mean, if you see the markets now, it is the entire space, number of choice have evolved, existing companies have got bigger, and the scale opportunity has become much larger. Today, the cutoff for mid cap is almost 65, 70,000 crores. So, and lot many new listings have happened. So in that context, that had to be slightly recalibrated. But yes, we continued with that stance because in that particular category, we're already leader. We have a decent SIP book, and we'd like to maintain a satisfactory sort of inflow. I mean, no one can sort of very fine tune it, but around 10 to 15% inflow per annum net inflows is what we are sort of looking at in that, so that the interest of existing investors and should the market go in different cycles, the liquidity should not be an impedance in terms of fund manager remaining sort of nimble footed.
Great, sir. And that truly reflects in the performance, even during bad times like COVID and all. Your fund was relatively less underperforming in comparison to the peer group. So you have mentioned a few times in our conversation about your team. Now, we do understand that leadership is extremely critical, but research is a collective effort. Now, if I have to just understand, if you would hire somebody in your team in research, say 20 years back or 10 years back, and now, what has changed over a period of time? And also, so when we advise our investors on mutual fund versus direct equity, one of the key factors is risk management. And how does the role of investment management committee comes into picture in the overall success of the fund and the fund house?
Sure, Harsh. Very interesting sort of question, different from the previous one. No, you are absolutely right that I mean the business is about people, philosophy, and processes. Obviously, the philosophy and processes is dependent on the team and the people. And the hiring in the equity research fund management, I think there are few important traits come to my mind. First, obviously, is the subject matter expertise, the sector expertise. It's an analyst and the analytical skills. And the candidates need to have demonstrate sort of strong analytical skills, number crunching skills, and the ability to interpret financial ratios, financial data, and link it with the investment opportunities, because our sort of job is more data driven sort of decisions. And in this context, experience is important, as you get learning only with sort of experience. across cycles. I think we also lay a lot of emphasis on the softer aspects if someone is in this particular profession, and that is with respect to the collaborative spirit or the teamwork which an individual should have. I mean, you have to work with your colleagues, colleague analysts, portfolio managers, and share ideas and collaborate to achieve sort of common goals. So that's also very important. And obviously, lastly, the most important thing is about the ethical standards. Integrity and ethical conduct is obviously paramount in any finance job, particularly in any role which has to do with fiduciary responsibilities.
Understood, sir. So whatever Warren Buffett said about selection of management for his set of companies, that is true for you hiring your team members also.
Yes.
So my next question is, if somebody young to your age, say 20, 25, comes to you and say that I want to make a career in fund management, wealth management, what would your advice be?
Yeah, so Harsh, I mean, I'm myself learning, so it will not be appropriate to give advice to others. That said, I'd say about fund management, money management, I think, yeah, based on the experience, I think the job obviously is very exciting and challenging. And one common thing is those who have passion should sort of pursue it because it's challenging also. I think the exciting part is that is the task to take trusteeship of or ownership of investors' wealth and compound it over a period of time is very sort of satisfying. But the challenge is obviously to generate superior performance. You have to answer for other performance also. You have to, when I say superior performance, is both vis-a-vis market as well as peers. And the pressure to get it right consistently is not easy. So that's why it's, as I said, both challenging as well as exciting. I think the only advice I would give is those with passion. Many of these sort of pressures get relatively easy or easier relatively to sort of survive in this industry. Yeah.
Right, sir. And with so much of information flow, I think the pressures have only increased in last few
Yeah,
years.
the noise has increased further. Yeah.
Absolutely, sir. So now it's very rare that we get an opportunity to speak to you, and we would not want to let go without having a rapid fire. Maybe I'll have 4 or 5, shooting questions. First one, India or US? Which one do you find more attractive for equities?
India,
Bottoms up or tops down, sir?
bottoms up.
Growth or value?
Growth at a reasonable
Someone,
price. We are not giving that option.
right, sir. And one important sector everyone is missing at this point of time, though we will know only in hindsight, but as per you, which sector are others missing at this point of time?
I would say the mass consumer discretionary space, mass market consumer discretionary.
Right, sir. And you have a fund in that space also, sir. So,
Yeah, we have a theme.
so one contra bet that you would take at this point of time.
I would say a couple of large private banks.
And so when we speak to other fund managers, a lot of them have mentioned your name as an answer to this question. Now we're getting an opportunity to ask this to you. One Indian fund manager outside your fund house, which you admire.
Mr. Prashant Jain.
Right, sir. And one last question. So one book which you feel is must read for all the capital market participants.
Yeah, it's a old book. I like Bill Fisher's Common Stock and Uncommon Profit. I mean, it's sort of timeless because it instills a rigor of research and emphasizes what Mega was mentioning earlier, that to look beyond numbers for better understanding businesses.
Right. So with this, we come to the end of our conversation, and it was very, very enriching conversation. And we have been trying to get hold of you for quite some time, and thankfully, we got the opportunity today. A few key learnings, which I think our investors would also like. One is avoid high price tag, even for greater businesses. Avoid quotational errors to deliver long-term returns. avail opportunities where near term is impaired, but long term is very much intact. Anything and everything which is 52-week low is definitely not a contrarian bet. Minimize error of omission and not commit error of commissions. And lastly, when you look at people around you, be it hiring or be it people who you would want to work with, you look at collaborative nature and high ethical standard. So with this, we end our conversation. Thank you so much for taking out time on a busy day and helping us and our investor understand your philosophy and your background in terms of fund management. Thank you so much, sir.
Thanks, Harsh. Thanks, Mega, for inviting me. Thank you. Pleasure was mine.